Hello everyone, hope you all are doing good. In our previous video we discussed about the OHL strategy. In today's video I thought of sharing an interesting observation that I made in Nifty 50 chart. Though I made the observation in a Nifty 50 chart, it can be applied to any stocks and also Bank Nifty index. So it is a quite simple observation that I made, but the returns are very high. I tried it more than once and then it gave me a very good result. So I hope this will help you in one or the other way. You can backtest it yourself. Let's learn. Before moving on to the strategy, we should be familiar with the two things. One is EMA and price action. So EMA, the full form is exponential moving average. There is many theoretical definition for that. And we'll be using 20 EMA. Next is price action. So in price action we have three things. One is bullish price action, bearish price action and consolidation. I think everyone knows what a bullish price action is. Bullish price action is where there is continuous higher highs and higher lows. Technically what that means is the price is moving higher in a fast pace. Next is bearish price action. Bearish price action is where there is a continuous lower highs and lower lows. So what it indicates is the price of a stock is continuously moving in a downtrend. Next is consolidation. In consolidation price action, we do not have any clear signal. So we will never know whether the stock is going in an uptrend or a downtrend. Sometimes it looks like a lower low and then it turns and moves in a uptrend and then again downtrend, eventually ending up in the same place. It is otherwise called as a whipsaw movement. Let's discuss this strategy in depth using the Nifty 50 chart. In order to explain this strategy, I have taken a November 28th Nifty 50 chart. So at 9:15 the market opened and it started to come down, and there is an exponential moving average I have marked here. The value is 20. So what it does is it takes the previous 20 candles value and marks an average. In exponential moving average, more weightage is given to the recent candles than the older candles. So for a 20 candle period, the recent candles will have more weightage and then the older candles will have less weightage. So this blue line that you see, that is the EMA. Now what happened on November 28? The market started to come down. Continuously it is coming down. Now at this period, if you see closer, there is a crossover. There is a crossover of the price along with moving average. There is a crossover of the price with moving average. Unlike moving average crossover strategies, this is different. Here, the price of the particular stock or an index crosses over with the moving average. I want to make that clear. Now what happened here is once the crossover is done, the price started to move down. Now this is the crossover candle, right? This particular candle crossed over with the 20 EMA. Now what we do here is we draw a horizontal line at this point and another horizontal line at this point. Now you can see clearly, another horizontal line at the high of the candle. Now I have marked the low of the crossover candle and the high of the crossover candle. The strategy is this. Whenever a candle crossed over an exponential moving average and closed below the EMA, closed below, note that point, it is not the wick, it has to close below the EMA, then one can go short. In this case, one can go short here around this range. Since it closed below, one can go short here. Now, where you will place the stop loss? The stop loss should be placed at the high of the crossover candle. So we have to place a stop loss at the high of the crossover candle. When I say place the stop loss, it doesn't mean you can put a value and place it in the system. It is an emotional stop loss. What you have to do is whenever a candle closes above this point, it is not the wick. You have to look for the closure. Whenever a candle closes above the high of the crossover candle, you have to exit from the trade. It is an emotional stop loss. One should exit from the trade. Now let's say we entered into the trade here and then it started to go down. What happened is there is a candle that closed below our current crossover candle. The moment a candle closes below our current crossover candle, we have to trail our stop loss. Now our stop loss from the high of the crossover candle goes to the high of this crossover candle. Why it is called as a crossover candle? It closed below the low of current crossover candle. But in this case, what happened? The price started to reverse. The moment it started to reverse, our stop loss is hit. This green candle closed above the red candle high. So we are exiting from the trade with a minimum loss. We entered here, we exited here. It is a minimum loss, that is a stop loss. What we have to do in this situation, you have to reverse the trade. We are going long. When we are going long at this point, where is our stop loss? The stop loss is the low of this red candle. During this time, since we have booked a loss here, this is our second chance. In the second chance, we should not trail our stop loss. We have to wait and let the price run. If our stop loss is hit, we are done for the day. If our stop loss is not hit, we have to wait and watch where the market takes us. In this case, the market moves higher and higher and ended in the highest point for the day. You can scroll through and check the other days. It doesn't happen often, but when it happens, it is very good. So on 29th, we do not have any crossover for 20 EMA. Let's move on to 30. In 30, there is a first crossover here. One can go short at this point. Our stop loss is here. Let me mark it. Our initial stop loss is here. The moment another candle closed below, we have to trail our stop loss. Now here another candle closed below, so we are trailing our stop loss. At this point, this is the lowest, right? Since we entered, since it closed below this candle, this is the lowest point. And when the price reversed, it closed above this red candle high, and we are exiting from the trade with a minimum profit. We entered here, we are exiting here with a minimum profit. So once you exit, we have to go long. From this point, if you go long, where is the stop loss? The red candle low becomes the stop loss. And you can wait for the entire day and you will get a profit. So the candle closed here around this point and we entered here around this point and we made a very decent profit. Let's scroll to other days, that is a December 1st. So on December 1st, it is a consolidation day. On December 1st, it is a consolidation day. If you see, the first crossover happened here. The moment it crossed over, we hit the stop loss. The moment you buy here, we hit the stop loss. So we are done for the day here. Now let's search an example for a bullish crossover. Let's scroll back. Where the first crossover is a bullish side. Here the first crossover is bearish and then we hit the stop loss, then we go for a bullish and again we hit the stop loss. So we are done for the day. Yep, on November 17th it happened. So on November 17th, if you check, the market opened very low and it instantly started to go up. where there is a bullish crossover here. The open price is below EMA, the close price is above EMA, and this is the first candle where it happened. Now we can zoom into that. So if you see here, this is the low point and this is the high point. The moment it closed here, one can go long. Our stop loss is the low point of the green candle. So it started to go up and closed above the high point. Now we have to mark the current high and we have to trail our stop loss. Next candle, it closed below our stop loss. So we have to exit from here and go reverse. In this case, we are going long first. It got hit, our stop loss got hit. Now we are going short. Now we are going short at this point and our stop loss is here. That is our stop loss. We are going short here, and if you zoom out, you can see the stock continuously goes down. It goes down, 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 and finally, oops, that is the next day. Now we can see that the stock goes continuously down and ended at the lowest point of the day, where we made a huge money. So this is a simple observation that I made. I hope this helps everyone. Let's do a quick recap. For a buy opportunity, the candle should close above the exponential moving average. That should be the first crossover candle. So the stop loss is placed at the lower point of the crossover candle. If any candle closes below the lower point, you have to exit from the trade and you have to reverse the trade. Once the SL is hit, we have to reverse the trade and wait. Similarly, for a sell opportunity, the entry is made only if the candle closes below the exponential moving average and stop loss is placed at the high of the particular candle. So once the stop loss is hit, you have to reverse the trade. Now, if both sides stop loss is hit, let's say first you get a buy opportunity, your stop loss is hit. Now you are taking a sell, that is reverse. You are in a reverse. Still your stop loss is hit. Then what you do? You just say you are done for the day and relax. Don't reverse the trade again. If you do that, then you will get caught in the consolidation. You have seen the consolidation, right? Once you get caught in the consolidation, you will book losses again and again. That ends up in a huge loss. So don't do that mistake. If you do not understand this strategy, you can go through the video again. Hope this helps everyone. Thank you all for watching.